Welcome to another session in the Arthashastra classroom, where we dive into the fascinating realm of economics. Today, we are unlocking the mysteries behind two crucial tools that shape a country's financial landscape: the repo rate and the reverse repo rate. The Reserve Bank of India oversees the total money supply to cater to the needs of different sectors within the economy and to facilitate a swift trajectory of economic expansion. The RBI operates under a dual mandate, which entails two main objectives. Firstly, it aims to maintain stable and moderate inflation levels to ensure price stability within the economy. Secondly, it strives to promote sustainable economic growth and employment generation, working to create a conducive environment for balanced development and prosperity. Imagine the economy as a seesaw, with the repo rate on one side and the reverse repo rate on the other. These two rates play a dynamic role in balancing the flow of money, influencing everything from lending and borrowing to inflation and growth. Think of the repo rate as the borrowing cost. When the central bank, like our RBI, wants to kickstart spending and growth, it can lower the repo rate. This makes borrowing cheaper for banks, prompting them to lend more to businesses and individuals. Repo rate. What is repo rate? The repo rate is like the interest rate the RBI charges when it lends money to other banks. Why is it important? Think of it as a tool to control how much money is flowing in the economy. If the RBI wants to encourage banks to borrow and spend more, they can lower the repo rate. This makes it cheaper for banks to borrow, so they're more likely to take loans from the RBI. Then, the banks have more money to lend to people and businesses, which can boost spending and growth. Impact of lower repo rate leads to banks borrow more from RBI, more money in the economy and potential for higher growth and spending. On the flip side, we have the reverse repo rate, acting like a lending incentive. If the RBI aims to tighten the money supply and control inflation, it may raise the reverse repo rate. This encourages banks to park more funds with the central bank, reducing the amount they lend to the public. Reverse repo rate. What is reverse repo rate? The reverse repo rate is the interest rate when banks lend money to the RBI. Why is it important? It's used to manage how much money banks keep with the RBI. If the RBI wants to reduce the amount of money banks are lending and encourage them to keep more money safe with the RBI, they can increase the reverse repo rate. This makes it more attractive for banks to lend to the RBI instead of lending to others. Impact of higher reverse repo rate leads to banks lend more to RBI, less money available for lending to public, and helps control inflation and reduces excessive lending. So, whether it's jump-starting economic activity or curbing excessive lending, these rates are powerful tools in the hands of monetary authorities. We appreciate your engagement with our vlog, Demystified Monetary Policy. Dive into the intricate world of economics as we break down complex monetary concepts into accessible insights. Gain a clearer understanding of how monetary policy shapes our financial landscape. Thank you for joining us on this enlightening journey.